Welcome to the Small Business Tax Savings Podcast, your weekly dose of accounting and tax tips specific to small business owners. You will be on your way to growing your business and paying the least amount in taxes as legally possible. Here's your host, Mike Jesowshek, CPA.
Hello and welcome back to another episode, and this is the third part of our mini-series on estate planning. For this series, we brought on Andrew Ayers to talk about the different aspects and different parts of estate planning. You probably know Andrew from previous episodes as well as from a series that we did last year. But this is, again, part 3 of our estate planning series. First, we talked about what is a last will and testament and why is it important. The episode after that, last week, we talked about what is a power of attorney and what healthcare documents do you need in estate planning. And today we're going to kind of wrap up this mini-series by talking about what is a revocable living trust and why is it important for business owners. So if you have not listened to those previous episodes, I'm going to recommend you go back and check those out. And then today we're going to be talking about, again, what is a revocable living trust. So Andrew, welcome back to the show.
Thanks, Mike. Glad to be here.
Excellent. So I think it's key that we talked about all these very different aspects, the will, the power of attorneys, the healthcare documents. Let's kind of wrap that up and just explain to us, what is a revocable living trust and why is this something that may be important, maybe something a business owner wants to explore?
Sure. And we've started each episode kind of generally talking about estate planning, and the first 2 episodes really gave you the basics. You need a will, you need your powers of attorney, your healthcare documents. You've created this estate plan, this system. And for many people, that's going to be all that you need. That's going to take care of your assets. You've worked with a financial planner. You've talked to Mike, your accountant. Everything's good to go. Today, we're talking about a revocable living trust, which is a more complex estate planning document. This is not something that everybody necessarily needs. Now, of course, if you listen to some of the other podcasts or you read the right magazine articles, some people will tell you that everybody needs a trust. We're going to talk a little bit today about whether or not that's the case. What I don't want you to do is take that magazine article or some podcast you hear and definitively say, yes, I need a trust, or no, I don't need one. Because the point is everybody's situation is different. You need a personalized estate plan, and whether or not that trust makes sense for you is a much deeper discussion than you're going to get from something you read in the latest issue of Forbes magazine. So the trust is really a more complex document, and what it does, it's set up to own something. So the trust is going to be a thing, almost like a company that can own certain assets. Now, there's no such thing as a U.S. trust, meaning one that just is generally from the United States. It's going to be a state-specific document. Now, this is important because your different states have different tax treatment. And I'm sure Mike can tell you if you have questions about whether there's going to be a better state for you to set up a trust in. And this goes to the importance of talking to the right accountant and financial advisor, because when we set up the trust, we want to make sure we're setting it up in the right state.
Yeah, and we're going to do an episode kind of on estate tax and how that works and kind of what taxes do happen when you die and how does that work into that. So we're going to be talking about those options in another episode.
Great. Yeah. And so the thing you should know about your trust is it can own almost any type of asset. And what it means is when you die, you don't have to file anything with the court regarding the assets that are in your trust. So if you're the trustee, which I'll explain in a minute, the successor trustee just takes over managing the trust for you. And the trust is going to lay out a plan for your assets after you're gone. What's in the trust is private. It doesn't have to be filed with any government. It doesn't have to be filed with the probate court when you die. And that's one of the more attractive parts of a trust to people. So there's really going to be 2 types of trust. There's a standalone trust, and there's what's called a testamentary trust. Now, if you listen to our first episode talking about wills, you heard about a testamentary trust because it's built into your will. And we'll often set them up when you have children who are under 18, because it can set up a structure for guardianship and a trustee to manage their assets. Today, we're talking about standalone trusts, and in this case, a revocable living trust. When you hear the word revocable, what this means is that you can make changes to it. So you can set up a trust, you can have certain beneficiaries, you have certain trustees, it's managing certain assets, but you can always make changes. What happens when you die, however, is it becomes what we call irrevocable, meaning no more changes can be made. So we're not going to talk about it today because it's a much more in-depth discussion, but a standalone irrevocable trust is one that can't be changed after it's been established. And it's way too complex for a podcast episode, but it's used for more advanced estate planning. So if you're in your middle age, maybe in your 50s, and you have a history in your family of health problems, people will then engage in an irrevocable trust because you can use it for Medicaid planning. It can get assets out of your name. And Mike can tell us a little bit about, people who can use a revocable trust for tax avoidance as well.
Yeah, no, definitely. And that's something we'll be talking about in that episode is kind of, the idea behind it is there's so many questions on, or something people don't think about is, okay, I've paid tax throughout my entire life. What happens when I die? And how does that work? And it's interesting that the vehicles that you put into place now when it comes to trusts and various things like that can help steer and determine what that tax looks like and who's getting hit with it or who's not getting hit with it. So it's important to think about that when we're looking at these types of items is obviously taking care of everything, making sure you're taking care of your family, making things easier for them. But also as part of taking care of your family after you pass is how do you avoid, let them keep as much of the money that you spent your entire life working for and assets that you have. How can we keep as much of that as possible for the people that you care about?
Yep. And when you're talking about an irrevocable trust, my only advice will be you do not do it alone. An irrevocable trust is a very complex estate planning document that has to have very certain language in it to be effective. So that is definitely not something you try to get off a website. You need to work with the right attorney who knows what they're doing if you think that's what you want to do. But again, that's kind of beyond what we're going to talk about today, because we're talking about these standalone trusts. And so what they are is they're going to be set up during your lifetime, meaning that once they're set up, you can transfer assets into them. And if you have a revocable trust, you can take assets back out if you need to. So my clients will always ask me, when do I recommend using a revocable trust? If there's pet trusts, if you have a pet that you want to leave money to, and we've talked about this in a prior episode, we remember Leona Helmsley and her dog Trouble, who lived in a big mansion and got to keep living in that mansion until the dog died. And then finally the house was sold and the money was distributed. So pet trusts don't have to be particularly, you don't have to have millions of dollars to do them. But if you want to leave a trust for your pet, you have a young cat, you have a young dog, if you have horses, horses are very expensive. A pet trust would be an example of a revocable trust you could use. What kind of hits home for more people is if you have a child with special needs, you can use a special needs trust in order to do planning for them to make sure that they don't lose their government benefits when you're gone. Your child with special needs who receives government benefits can't directly inherit your estate. If they do, they then have assets in their name and they can no longer get their government benefits. So it's very important if you have a special needs child to make sure that you have a trust in place so that you can protect their benefits. Another reason people may use them is for anonymity of ownership. Let's say you want to buy assets, but you don't want anybody to know you own them. You can use a revocable living trust to do that. Now, people always ask, why would I want to do that? You may have, you're running a business, for example. You don't want people to know what assets you own on the side, because if the business gets sued, they're going to sue you as well individually. And so Mike doesn't want to have all these assets in his name if he's sued individually. You want to have it in a separate trust. The mistake people make is they would set up the Mike CPA trust. So it's not exactly him, but it's a little bit different. But you're being sued and people can find it. So what you want to do if you want to really look for anonymity is you want to create a great structure for a name so that there's no indication that anything in that trust has any tie to you. So for Mike, instead, we would use, let's say, the Wisconsin Badgers Packers quarterback 2027 trust. Now, if you're suing Mike and you're trying to figure out where his assets are, there's nothing in the name of that trust that would indicate that Mike has any interest in it. So it's a good way when you're creating a trust to create that anonymity. If you're working with famous people or you become infamous for some reason, put your house into a trust like that and get it out of your name so that when people search public records, they don't see that the house is owned by you. There can be a lot of reasons. If you're going into politics and you don't want people to know where you live, you can move your house into a trust with an anonymous name so that it's not all over your property records.
Now, I do have a question on that. By having that trust alone, does that protect the assets in there from being touched in the event of a lawsuit? Or is that just more so avoiding people from potentially finding all the assets that you have?
It's really more for avoiding people avoiding people being able to find that asset is really what I mean. People can get through the trust if they really try, but normally they won't be able to do that. What we don't want to do is have all this information out there about you and what's in the trust, because these trust documents are private. Even after you die, they're not filed with the court. So when you properly name your trust, you then have given yourself an extra barrier of the assets you own. Because these probate records are public, but what's in your trust is not public. And you can also use a trust to manage your money. So we talked a little bit in the last episode about powers of attorney. And if you have a provision or you have a situation where your mother or your father is getting older and unable to manage money, you can move their assets into a trust and have a child or another family member be the trustee and manage the money for them. Now, one of the reasons everyone asks, should I get a trust? But some people ask, why shouldn't I get one? And a lot of people will come meet with me, and this will be the real discussion we have, is whether or not I recommend the trust for them. So if you're coming to me and you want a trust for tax benefits, a revocable living trust is not going to get it done. That's not going to be my recommendation to you. You also have to know that you're going to have to retitle all of your assets. So if you're going to move your house into a trust, if you're going to move your financial accounts into a trust, whatever you do, you're going to have to change the title on all of those assets. So there is some legwork that has to be done. One of the biggest mistakes I see with people putting their house into a trust is that you need to make sure your homeowner's insurance policy also reflects that the trust owns the house. Otherwise, you've created a gap. And if somebody sues you and they want to go after your house and you say, my insurance is going to protect me, it's not a problem. The insurance says, wait a second, your name is still on the house, not the trust. Now you've got a problem, and the insurance company may deny coverage. And then all this planning you've done to try to protect your assets is undone by a simple step of calling the insurance company and making sure that they know who actually owns your house. So with all these little steps, this shows the importance of working with the right professionals. You got to work with your accountant, work with your financial advisor. When you're setting up the trust, work with an attorney so we make sure that trust is set up correctly. Now, we've also discussed in the will episode and a little bit today about, avoiding probate and using the trust so that the documents don't have to be filed with the court. You still do need a will. So what we'll normally do is create a much shorter will that pours over whatever assets you have left into your trust. So it's really just whatever you have at the time of your death that's not in the trust then gets put by your executor into the trust. The will also allows you to name guardians for your children. This is not something you can do in a trust. So don't think you can, if you have children and they're under 18, you can't just make a revocable living trust and think you're done, because you still need to make sure you have a guardianship provision for your children. Because the trust only lets you decide what those children get as part of their inheritance and when they can inherit it. It doesn't have any provisions for guardianship. So I've thrown on a bunch of terms here and there, but there's 4 major components to a trust that you need to understand. The first one is what's called a settlor or a grantor, and that's you. That's the person who's setting up the trust, the person who's transferring assets into the trust. So you're the originator of the trust. The second person is the trustee. So the trustee is the person who's managing the assets, making distributions, doing whatever the trust says. Now, you can be the trustee of your own trust. So you don't have to set up a trust and have somebody else be the trustee. It's often done, an example of an older relative who needs somebody to manage their money, but many clients will set up a trust where they are the grantor and the trustee, meaning they've set up the trust and they're going to manage the trust while they're alive. Married couples will often do it where they're initially both the trustees. If one of them die, the other one continues as the trustee, and then we will get to the successor trustee after the second one dies. The beneficiaries, the third main term you need to know, are the people who get the benefits of the trust. Beneficiary benefit. That's how you kind of easily remember it. And so if there's money to be paid, it goes to the beneficiaries. You can be the beneficiary of the trust. So if it's the older relative who needs money managed for them, the trustee manages the money, and the grantor can be the beneficiary, the one who gets the money while they're alive. And then once they're gone, we can have the beneficiaries be somebody else. And then the final component of a trust is the property. What's in the trust? The assets, the bank accounts, life insurance proceeds, whatever the trust owns is the property of the trust. When you're setting up a trust, it's very similar to a will in that you need to make sure the technicalities are followed. You don't want to just sign the whatever trust document you have that you got off a website and hope you've done it correctly. One of the things that the little one of the little things that lawyers know that LegalZoom won't tell you is your trust actually has to be signed before your will. So technically, if you have a will that's going to pour your assets over into your trust, if you sign the will first, it says I pour it over into my trust, but the trust isn't in effect yet, that's technically an ineffective will. So you may be sitting at a conference room table. Let's say you've printed out your documents from a website, and you may just run through and sign it with the notary and not realize that technically, and there's magic language we use when you sign it, you want to sign that will, you want to sign the trust first and then sign the will, because legally that's the order they have to be signed in. And that's one of those little mistakes that can cost you a lot, but working with an attorney will make sure that you've done that in the right order. When you're signing your will, you're often going to sign other documents too, like an affidavit or certification that the trust exists. And this kind of document is the one that's going to be given to financial institutions who are going to manage property for the trust. So if you're going to move your bank account into a trust, they will often want to see either an affidavit or a certificate proving that your trust exists. So, and Mike, I don't know how often you end up working with clients who have trusts or dealing with their tax issues.
Yeah, no, I mean, we definitely see it often enough, especially kind of with business owners. And when we're talking about these types of things, it's really just kind of getting everybody aligned as what makes sense or what doesn't make sense for you specifically. And so I think when we look at the things we've talked about, it's not necessarily one or the other. We do this or that. We do a power of attorney or we do a will. We do a will or we do a trust. It's the idea of taking all these different estate planning items, finding out which ones are going to be most important to you and implementing them in a way that makes sense in your situation. And so I think it's important to have that discussion with an attorney, go through kind of the specifics that are going on in your life. And also, as we've talked about, is revisiting these things. It's not a set it. None of these items should be a set it and forget it for 60 years. These should be things that we're revisiting on a regular basis.
Yeah. And if you're a business owner, we want you to have success. We want that business to grow. We'd love for you to be the famous business owner on the cover of Forbes. But if you're in that situation, you don't want people to find out where you live. So that's a perfect example of when, as a business owner, you may want to put your house in a trust so that when people are trying to figure out where Mike lives, because he's the hot CEO in town, we want to know, we all want to see what his house looks like. We want to go on Zillow and figure out what's going on. You can put that house in that trust, and that allows you that anonymity. And that's one of those things that I think smarter business owners spend that time and think about, what's the best situation for me outside the business? And can that trust really help me on the personal side? You've set up an LLC, let's say, to give you all the protection in case the business gets sued, but we don't think about the back end of, we live in that culture where people try to dox you all the time and find out all the information they can. And using a revocable living trust, you can at least take one bullet out of their arsenal and give you some anonymity about things that you wouldn't want the public to know about.
Mm-hmm.
So when I'm doing trusts and I'm working with these business owners, there's about 5 mistakes that I commonly see, and we want to make sure that you're not going to create these same mistakes. The first and the most important is just using a generic trust that you find on a website. You may have certain ideas of what you want to have happen, and you may sign the completely wrong form. You might even accidentally sign an irrevocable trust, in which case you created a problem where you can't even get things back out. You can't manage the assets anymore. Second mistake that people make is you don't create a successor trustee. So let's say you and your wife create a trust, everything's going great, but you don't have a successor trustee. Then when the second one of you to dies, there's nobody there to manage the trust. And now you're going to be setting up some kind of litigation amongst your family to figure out who's that next trustee. So we want to make sure we have successor trustees that are actually nominated in the document, and we have a schedule of who goes next. And you can change that too. Down the road, if you say, you know what, I don't want my brother to be the successor trustee anymore, we can go back and amend the trust and change it. It's not that hard. The third mistake is not drafting any other documents, like Mike was just talking about. This is not an if, one or the other thing. This is we want all of these documents in your estate plan. If you're doing a trust, you want a will because there may be assets out there that you don't put in the trust or you forget to transfer over, and the will can fix that for you and catch that at the end. And you definitely want your powers of attorney and your healthcare documents. The fourth biggest mistake, which is far too common, is failing to fund your trust. When you set up your trust, you don't have to put millions of dollars into it, but you need to have some way to put money into the trust. If you're going to use a life insurance policy, make sure that the beneficiary of that policy is the trust. If you're going to do retirement assets, make sure the beneficiary is the trust. But far too common is people who come to meet with me and they've spent all this money on this trust and it's great, but they've never transferred any assets into it, and their beneficiaries aren't transferring assets into it, and it's just going to be there. I mean, the trust is just, it's a thing. It's, it's able to manage money, but there's no money for it to manage. And you're then just leaving a big hole in your estate plan, and your beneficiaries are going to be looking around going, where'd our money go? Because instead of the money going to the trust, it went to your will, and maybe your will didn't pour it over correctly. Or if it goes to your will and then goes to the trust, you've created a tax problem. This is where people like Mike have to come in saying, well, listen, your life insurance policy should be rolled directly in your trust. Whereas if it's going into your will and you had a $20 million policy, we've now got an estate tax problem.
Mm-hmm. Yeah. And I think when we talk about this, failing to fund the trust, is one benefit of having a trust is this idea that if you have multiple life insurance policies, you have multiple brokerage accounts, you have multiple retirement accounts that are kind of spread around, is one benefit of the trust is that you can just make the trust the beneficiary in all of those. If things change, you have grandchildren, you have children, now we're just updating the will and the trust to update that instead of having to constantly be changing our beneficiaries across all these various different accounts that we have.
Absolutely. That's one of the biggest benefits. And then, another benefit is, you don't want, not everybody wants their family members just to get a lump sum of money and just be able to spend it. So, you may want to take that life insurance policy, put it into a trust with a trustee so that it can be given out to the right people in your family at the right time. I'm not saying you don't trust your spouse with $5 million, but you may not want your spouse to just all of a sudden inherit $5 million when you die. You'd prefer to have a trustee there to help them manage it because, if they're not great with their checking account, how fast can that $5 million be spent? And they've created all kinds of tax problems for themselves as well. Whereas the trust has the trustee and has distribution guidelines. Or in the case we've talked about before, if you have a blended family, you may want that money to go in the trust so that the trustee can distribute the money to the right people and not to stepchildren who aren't your children, and you wouldn't want to have your money where they may inherit it directly from their mother if you had given it to her as a direct beneficiary. So, and this goes back to, we've talked before about not just having a general rule where everybody needs a trust or everybody doesn't need one. Each situation is very personalized. Trying to just take some trust off a website that you think will work can create a lot more problems, whereas a meeting with some financial professionals like Mike, like a financial advisor, like an attorney, can make sure that we get the right trust put in the right place for you.
Yeah. And I think when we talk about, we talked about with the wills and the power of attorneys and the healthcare documents, again, people think that these things are very expensive. They take a lot of time. Many people think, I'm a lonely millionaire. I don't need a trust, or I don't need a will because I'm not a billionaire. And they think of these various different, people just get different things in their mind when they hear these words trust and will. They think that it's not relevant to them. It's part of that feeling invincible thing too. So give us some idea of what we've come to realize is that it's not necessarily one or the other. We're not just going to do a will with no power of attorney. We're not going to just do a power of attorney with no will. We're not just going to do a trust with no will and no power of attorney. So when we look at what is the perfect fit, what is kind of what we need, that's what we're going to do in estate plan. And let's imagine that we do an estate plan and we want to do a will, we want to do a power of attorney, we have healthcare documents, and a trust makes sense. When we look at the cost and time commitment involved to sit down, talk about that, get those set up, what are we kind of looking at just to kind of give folks an idea of how this can be reasonable for your average person?
Right. And I think a lot of it comes down to what you want your trust to do. So, your estate, and you don't have to have a big complex estate plan to do a trust. But when it makes sense to do a trust, you want to make sure you're getting the right advice. So I talked before about, for example, the importance of a special needs trust if you have a child with special needs. That trust is a little more time intensive because you want to make sure you're selecting the right type. There's first party, there's third party, there's pooled trusts. Each one is a different type of trust for a child with special needs. Each one takes different drafting, and each one has its own requirements to make sure we protect government benefits. So those trusts are going to be a little more time intensive and a little more expensive. Now, a lot of other people will do just a basic revocable living trust with their will. And all we're going to do is just going to have it there just in case down the road we want it. We're not even going to put a ton of assets in at the time. Maybe it's just going to be funded with a life insurance policy when somebody dies. Those are relatively simple. They're not tough to set up. The real cost and the expense in these comes when you get to the funding stage. And this is where working with an attorney versus a website is really important, because the website's not going to help you fund any of these. Working with an attorney will make sure that you get your trust funded. We make sure we get the right assets transferred. If we're transferring a house into a trust, your website's not going to do that for you. Your attorney's going to create a new deed, have to file it with your local government, the local registrar for property. And these are the steps that will take a little more time and have a little more expense. But that's the purpose of the trust versus just setting up some other document that you got on a website that you don't actually end up funding in the end. So the cost for a trust can be anywhere from $1,000 to $5,000 or $6,000. It can be more than that. It depends on how complex you want to make, frankly. I'm always leery, when I have first phone calls with clients, that's always one of their questions is, how much is this going to cost? And my answer is always, well, we've only talked for 15 minutes. So I don't know, because let's talk about what you want to do. What are your goals? What do you want to do with this trust? If we're doing a trust with a special needs component and we're thinking about Medicaid planning down the road as you get older, that's a very complex trust. It's going to take a lot of time and a lot of careful planning and drafting of the documents. If we just want to have a trust, for example, I'm a business owner, I just want to have a trust there with a separate name for anonymity, and I may use it down the road. That's a simple trust. It doesn't take a lot of time, and there's not a lot of funding responsibility that goes with it. So, I think the key is you have to look at this as a whole as part of your estate plan, and the cost shouldn't scare you off, because if you're going to put a $5 million, let's say you're going to put a $5 million life insurance policy into a trust, is it worth it for $1,000 to create the trust? Or do you just want to game it on a website and hope it works? But if you mess it up, that $5 million goes into your estate, creates an estate tax problem, and then you're in Mike's office going, for $1,000, I could have saved all this problem, but now I owe 30, 40% of that $5 million because my local state has an estate tax on anybody over $2 million.
Yeah. And so I think really the moral of the series and really the goal is to let you know and give you an understanding of the various parts of estate planning. Now, what we've talked about in these last 3 episodes, first off, we started with the last will and testament, the power of attorney and healthcare documents, and then today the revocable living trust. What we've talked about is just scratching the surface on these things. And really the intentions is I want to have listeners that are successful business owners that are building families. I want them to know how important this type of stuff is. And that's exactly why Andrew Ayers came on and started to talk about this. So my hope is that listeners listen to this little mini series that we did and say, yep, I think it's time. I'm going to take the time out of this. I'm going to contact an attorney. I'm going to take a couple days to just get everything sorted out and then move on with it. And all we need to do is revisit this every couple of years. It's not something that we have to continuously think about. Doing these trusts, doing wills and stuff like that can sometimes be sad, I would say, thinking about what's going to happen when you die. But I can just assure you that just knowing that you're taking care of your loved ones, especially if you've gone through a situation like this, how hard that can be, it is just really going to help you out in this area. So Andrew, I just want to thank you for kind of taking the time. If you have not listened to the previous episodes, what is the last will and testament? What is a power of attorney? What healthcare documents do you need? I recommend checking out those and kind of finalizing that with this episode. And Andrew provided a ton of information for us throughout this mini series. We're going to have some document checklists that we're going to have in the show notes, as well as part of our tax minimization program. Andrew did a series with us on there that we did on estate planning for small business owners, which kind of wraps this all together. So if you are not part of our tax minimization program, check that out now. All previously monthly group training sessions we have recorded. And so you can check out Andrew's presentation that he did on that for our program there. You can find our tax minimization program at taxsavingspodcast.com/tax. Andrew, where can people reach out to you? I'm sure a lot of people are going to be listening to this and saying, I need everything that we're talking about. How can they reach you? What can be some of the next steps that they can go with you?
Sure. So my website is andrewmayers.com. If you want to look for me on any of the social medias, it's just Ayers Law, AYERSLAW. And, to piggyback on what Mike said, you spent all this time creating this business. You're working hard. You've got all these plans. there's no reason not to have it on the personal side as well. This is just as important to your personal life and your family as all those business plans and all those things you're doing for your business are. And it doesn't have to be time intensive. It doesn't have to be complicated, but it needs to be there to protect you and your business.
Excellent. Well, Andrew, thanks again for coming on and doing this mini-series with us. I think it is so vital and important, and hopefully this has just been that little fire that so many listeners needed just to kind of start this process, continue the process, or maybe they've done this a while and now it's that fire to remind them that, hey, it's time to revisit that. So thanks, Andrew, for coming on.
All right, thanks, Mike.
This has been another episode of the Small Business Tax Savings Podcast. If you enjoy our weekly episodes, please leave a review and share with other business owners. You can find previous episodes and more information at www.taxsavingspodcast.com. Thanks for listening and have a great day.